first thing I just want to step out and define is volatility in itself. I think volatility can be a word that is a catch-all for the way people want to enthuse a certain feeling behind it. But there are really two ways I think about the dimensions of volatility. One is, of course, the concept everyone's familiar with, which is the rolling average, a standard deviation of returns. But there's a greater nuance to this number, which is that it's a static snapshot that doesn't represent the distribution of outcomes that are possible as well. So when I think about risk, I often think about not just a static snapshot of a rolling window, but also the distribution of probable events that are possible within that risk spectrum. And then thirdly, the severity of that risk event, which actually does matter in the construct of volatility and the impact that it can drive. And I think all of these concepts come to life when we talk about options, because options are ultimately path-dependent financial instruments that create leverage in the system. The thing that I'm so excited about with ETF options, and I think what most people underestimate, is not that different from how people used to say the spot ETFs would be irrelevant because we already have all the ways to access spot assets by Coinbase and other regulated exchanges, that the ETF itself is a nothing burger. And of course, we all learned this is wrong.